Hi, it's Anthony Molinaro.
And I'm Timothy Jagger with your property market wrap on the results of July 2026. We'll cover home prices, rents, strongest performing regions, current auction conditions, and market factors now shaping buyer, seller, and investor sentiment.
Now, July marked a clear change in direction for Australia's housing market, with the downturn becoming broader and gathering pace. Cotality's National Home Price Index fell by 0.7% during the month. The weakness was concentrated across the capital cities, where values declined by 0.9% in July and 2.5% over the quarter. Regional markets continue to outperform, but they were not immune, with the combined regional index falling by 0.2%.
The metropolitan Melbourne. Melbourne has recorded a 1.2% decline in dwelling values during July, taking the quarterly fall to 3.4%. Values are now 2.8% lower than a year earlier, with the median dwelling value falling to $797,000. Melbourne dwelling values are now 5.5% below their March 2022 peak, while the city experienced a period of recovery through 2025. The cycle peaked in November and has since reversed as higher mortgage repayments, reduced borrowing capacity, and weaker consumer confidence have weighed on demand. The current downturn also remains weighted towards expensive properties. Nationally, upper quartile dwellings values fell by 3.2% over the last 3 months, while values across the lower quartile increased by 0.3%. This highlights the continued importance of affordability, particularly in Melbourne, where buyers are becoming increasingly selective and borrowing limits are placed greater pressure on higher value markets.
Now let's focus on regional Victoria. Regional Victoria continued to outperform Melbourne on an annual basis, although momentum also weakened during July. Dwelling values fell by 0.3% over the month and 0.4% over the quarter. Regional Victoria is now at 0.6% below its May 2026 peak. The annual figures remain comparatively strong, but the latest monthly and quarterly results suggest that affordability and serviceability pressures are beginning to affect regional buyers as well.
Now, over to the rental market. Rental conditions remain tight despite some moderation in the pace of growth. So house rents were up by 5.2%, while unit rents increased by 4.9%. Melbourne's gross dwelling rental yield rose by 4.0%, the highest among major capital cities, and Sydney's 3.3% and Brisbane's 3.4%. Regional Victoria recorded a gross dwelling yield of 4.2%, including 4.1% for houses, 4.8% for units. This continues to provide regional investors with a higher income return than the Melbourne market, although challenging taxation settings and higher borrowing costs are likely to remain a constraint for investor demand.
Now, around the grounds, the strongest annual growth continued to be concentrated across Melbourne's more affordable outer areas. Sunbury and Brimbank led the city, while Casey, Melton and Bacchus Marsh also remained in positive territory. Metropolitan Melbourne, while the strongest SA3 markets ranked from 1 to 5 were Sunbury at 729,000 with a 4.3% increase, Brimbank at just over 720,000 with a 3.7% increase, Casey at just under 800 with a 2.8% increase, and of course Casey North and Melton just under 700,000 with a 1.7%.
The strong Victoria's strongest SA3 markets rank SA3 market median dwelling values annual change. These are all Latrobe Valley, 518,000 at 14%, Grampians at 390,000, Ladone at 428,000, Glenelg at 12.1%, Ballarat at 11%.
The more important trend for sellers is the challenging and changing balance between supply and demand. Melbourne had 44,044 properties advertised for sale in June, 19.6% more than a year earlier. Now, buyers therefore have more choice, particularly across established and higher value markets, and are less likely to compromise on price, with presentation and property condition paramount.
Now, interest rates, inflation and consumer confidence. The Reserve Bank left the cash rate unchanged at 4.35% in June after increasing rates by a cumulative 75 basis points during the first half of 2026. The RBA indicated that inflation remained too high, but that holding rates steady would allow it to assess how the earlier increases were flowing through the economy.
Now, the annual inflation eased to 3.8% in June, down from 4% in May, while trimmed mean inflation remained unchanged at 3.6%. Housing costs increased by 6.8% annually and remained the largest contributor to inflation. The figures reduce some of the immediate pressure for another rate increase, although inflation remains above the RBA's target range and interest rate relief is not yet assured.
Now remember that information provided is of a general nature and you should always seek independent legal, financial, taxation and other advice based on your unique circumstances. Thanks for taking the time to watch this month's market wrap, and until next month, it's
Bye for now.